Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for September 27th of 2021. Please see our disclaimer for important information. Well, as we dig into the data this week, we'll start first with our high frequency data, courtesy of First Trust, our friends in Chicago. And as you can see in the right-hand column, we are beginning to see a little bit of a positive turn in some of our high frequency numbers related to open table, restaurant activity, TSA checkpoint data, getting an expansion a little bit in a commercial flight schedule, as well as an increase in the distribution of gasoline and sales of gasoline. So those areas had been fairly weak over the last month, and so it's really nice to see a positive turn. In some cases, like with TSA checkpoint data and open table, we actually saw a reasonable increase over the last week. Now, 1 week is not necessarily habit forming, so we want to watch that. But against that backdrop, we've got a little bit of moderation in some of the manufacturing categories like rail car traffic, steel production that have been weak for some time, but they're not materially weak. We've seen some really strong numbers out of production, out of manufacturing, and so it's only natural to assume that we're going to have a little bit of a pullback, and I think that's really what we're seeing right now. But overall, decent numbers out of the high frequency data. Here are some graphical representations of some of that. So you can see open table, again, kind of recovering just a tad. You can see where we were in 2020. Obviously, we're well above that level. Again, some seasonal gyrations in this, I might say, as well as some clear impact from the Delta variant, but we're beginning to see where that's moderating. Motor gasoline, lower left, you can see that number is beginning to look a lot more like 2019, which is a really positive development. Hotel occupancy, again, that's looking a little bit more like 2019, and there are some seasonal variants and variations that kind of play into that number. And then TSA checkpoint data, obviously we're still below 25%, if you will, below where we were in 2019, but we have narrowed the gap. And here's our COVID tracker. As we've been watching over the last several weeks, we did see the peak in the blue line here, which is a 7-day moving average of daily new positives. That one began to roll over. We wanted to make sure that it wasn't a false peak, and indeed it actually turned out to be, at least for now, the peak of this particular cycle. We did see the little fish hook turn up in cases, which we wanted to monitor to make sure that wasn't perhaps getting ready to establish a new high. And in fact, we do see that number rolling over. However, at the same time, we're seeing an uptick in our 7-day moving average for daily deaths. And a lot of these are happening, still amongst these numbers still highly represented by the unvaccinated. And also on the daily death side, we're seeing an increase or an uptick, if you will, in cases related to the elderly. As we get into some of the economic data, one of the things that I thought was really interesting from Deutsche Bank here is retirements have really spiked up. So this is essentially taking people out of the workforce, and we do know that labor participation has been a bit challenged, and that people have left the workforce for various reasons. And you can see here that this is a study of retirements, so basically number of retirees versus the trend line. We're clearly above that, and you can see where that deviation began, and it was essentially at the pandemic. So an increase in retirees, essentially taking people out of the workforce. Here's a note from S&P Dow Jones showing you, I thought this was very interesting because we've been monitoring the increase in stock buybacks and dividends. Companies are flush with cash because earnings are good. We've in particular been watching the rate of dividend increase on the part of the S&P 500. This happens to be returning shareholders by way of share repurchase. What's interesting here is that, as it shows on this Bloomberg page, the top 20 companies account for more than half of all stock buyback outlays. And if you, obviously if you take out Apple, then that changes the equation quite a bit. But Apple is a huge influence on this number. I'm going to switch gears here and talk about housing affordability. And as much as we've been spending on the U.S. market, this is actually a view of the global backdrop. Now, what we've been saying about the domestic market is that we have incomes that are going up and have been going up for some time. In some cases, in some periods of time, maybe not necessarily as much. But they are going up. But lately, we've seen housing affordability go down because house prices are moving up faster than incomes can keep pace. And so we've pondered what the implications are for the U.S. there. But this is clearly not a U.S. problem. And if you look at this chart, basically it's a housing price to income ratio. And it's reflecting a percentage change from 1995 to 2020. And if you go down, start from the top, you've got a pretty broad representation of European and Scandinavian countries, as well as the UK. Some countries down at the bottom have had, those numbers go a different way. But this is clearly evidence that this is not a U.S. problem. The housing affordability is, in fact, a global problem right now. All right, here's a chart from First Trust showing non-defense government spending, and usually we show this, both non-defense and all-in government spending, relative to an annual budget number. Well, this is plotted against gross domestic product, or basically, what's the percent of non-defense government spending as a percent of the economy? And you can see right now it's approaching 30%, and this is uncharted territory for us. I mean, after the global financial crisis, we struggled to get up to 20, and then we backed off because there wasn't stimulus payments, even though the Federal Reserve was buying treasuries, which isn't counted necessarily in the government spending. Those are open market activities on the part of the Fed. But what we can see here is not only by a byproduct of one stimulus round, but multiple stimulus rounds, have driven our non-defense government spending really, really high right now. All right, we're going to talk about inflation and interest rates, and I've got two charts here I thought were really kind of illustrative of, really almost both sides of the argument. So, we have been monitoring both inflation and interest rates. We talk about both of them, kind of almost ad nauseum. And what you see on the left-hand side kind of takes us back to the beginning of 2019. These two charts were provided by FS Investments in a research piece in which they're kind of comparing inflation and interest rates. You can see, what appears to be a mild positive correlation over, this time frame dating back to the beginning of 2019, and then this huge deviation where you see both the all-in consumer price index, or CPI, as well as the ex-food and energy, or what's commonly referred to as core number, really jump high and spike at a time where we haven't had much of a move in the U.S. Treasury. And that is somewhat odd because there has seemed to be this positive correlation, but when you dig between the numbers and you do the due diligence on the right-hand side, in numbers that go back in a data series that goes back to the beginning of this century, 2000, you can see actually that there's very low correlation between these two. And so, what the takeaway here is, it would be a traditional response because, the common perception is that a 10-year yield longer-term Treasury rates tend to reflect inflation expectations, and that's true. Sometimes they don't work in lockstep, though, and that's actually what's happening right now. Frankly, almost from the beginning of this year, where we have seen some of these material inputs, and that's because the expectations factor is very powerful right now. And what I mean by that is that there's very strong feelings out there that this inflation is temporary, transitory, it's going to go back down, and it could go back down to 2.5, which I think would be reasonable. And at that point, you may get some positive response out of these interest rates, but they remain just extraordinarily, disconnected, at least by all appearances, to interest rates. But generally, over time, they do converge a little bit better. Now we're going to talk about inflationary pressures, and we've been watching some of these time series, and on the left-hand side we've got the all-in CPI, but what we've also plotted here is really interesting. This is again the work by FS Investments out of Philadelphia. A great work, great economics team. Laura Rame does a great job there. And so what she has done in her work is kind of break out the reopen inputs and hospitality. And here she breaks out autos, because we've had choke points in the automotive industry. Rental prices have gone through the roof, so on and so forth. So all of these reopening issues have been stripped out, and you can see that the impacts are a bit more muted, right? And so so the numbers that we have seen in the headline consumer price index are indeed high, but they're not necessarily as bad if you strip out the impact of these reopening. And we've talked about this before, but I thought this chart did an excellent job of kind of isolating the impact of the reopening from the overall number. And with that, it gives you a little bit of comfort in that the CPI number that we're seeing right now is really influenced by kind of a fairly narrow sector of the economy, but it is still higher than it has been, at least. Now, if you look at the right-hand side, this is something that that we really need to watch, and we really do care about, because when you talk about wages, and if you're seeing wage growth, which we are, again, the black represents the 2015 to 2019 annual increase, if you will, and then kind of the orange bar represents 2021 year to date. And you can see that in every category we have accelerating wages: manufacturing, construction, trade, services, yada yada yada. And the impact here, or the implication rather, is that accelerating wages can be very sticky, and it's harder to take wages down once they've gone up, unless you've got a major economic problem. And right now, of course, we're in an expanding economy, so we're going to need to watch wages, because they could influence the consumer price basket in a way that might be a little unexpected. Here's a quick look at the bond market and its interpretation of inflation right now. So TIPS represents the Treasury Inflation Protected Security. This is the plot of essentially the break-even inflation for the 2-year TIP and the 10-year TIP. And so, what this is essentially, what this number represents is if you take the Treasury Inflation Protected yield and you subtract that from the corresponding Treasury bond, so like the 10-year TIP yield is subtracted from the 10-year Treasury note, and it gets you this implied or inferred inflation expectation number. And so what we see now is both at the 2-year and the 10-year, we're kind of huddled around this 2.5% level. And as you can see, it's higher than where we were. Again, no surprise, I've been talking about this quite a bit, but it seems to be coalescing at a level which honestly I feel like, it's a level that the economy can sustain. And if this does play out, and I will give the bond market a lot of credit for perhaps being a better interpreter of what the future holds for the economy, certainly than the stock market. But if we have 2.5% inflation, that's actually not necessarily bad, and it's reflective of an expanding economy as well. Here's a chart that I saw in a Twitter feed for Schwab and Liz Ann Saunders. So it shows you in blue money market funds. So, I mean, these are idle funds sitting on the sidelines. You can see that, we've actually been increasing that for a number of years, even dating back to like 2017. We were already starting to, increase money market balances, and so everything went took a hit the accelerator once we went to the pandemic and had the shutdown. So a lot of people raised cash, went to cash, holding cash, then they started putting it back in the market. Now we've kind of perked back up a little bit. So that's the blue line. So that's kind of the aggregate number, if you will. Now the orange line is kind of interesting because it shows you what the value of all those funds is, basically what's in the blue divided by the S&P 500 index. And so, Liz Ann's point here was that, back in the global financial crisis, 2008, 2009, you had a lot of liquidity on the sidelines. We actually have more now, but it was high relative to where the index was. Now it's extremely low. And so the argument here is that all of this money on the sidelines, because the market has appreciated, it's not as powerful an impact as it was back after the global financial crisis. Here's a quick look at household balance sheets. And, we've been talking about this off and on for many months now. And this is not necessarily a new phenomenon. I mean, on the left-hand side, you can see that that this has been playing out over a number of years, and it really is almost accelerated as of late. The main thing to look at here, and one of the drivers of this is this massive deleveraging, which is in that orange bar for liability. So liabilities as a percent of disposable personal income continue to go down at a time where household asset values are moving higher, and so as a result your net worth is going up, and we've seen an acceleration in that in a relatively short period of time. And if you go back to the right hand side, these are incomes. So on the left hand side you've got household balance sheets. Right hand is income, and these are all influencers into having strong balance sheets and deleveraging and paying off debt and everything like that. You can see some of these components. Obviously, income from wages have been important. To some degree, stimulus checks over time, but it's certainly in certain spots, like when we had rounds 2 and 3 at the end of last year and kind of the first quarter of this year, those were huge influencers. But you can see that as we get further into this year, that we're getting greater contribution from overall income from wages and other private sources than we are from other areas, knowing that some of the stimulus is going away. Household bank deposits. So this is something that is a direct manifestation of increased household income and also decreased leverage on the part of households. So what you wind up getting is you've got a lot of bank deposits. You've got a lot of liquidity sitting on the sideline. And as stimulus payments were being made, this was the point that we made last year, that stimulus money that went to the lower socioeconomic layers was being spent, like in total. The money that was going, really kind of arbitrarily to everybody, but the money that was going specifically to the higher income cohort was being saved. And you can see some of that manifested in this number. You can see the rapid acceleration during the pandemic and the pandemic assistance period in these balances. And we clearly have deviated from this extrapolated trend line by, somewhere on the order from long-view economics perspective by almost $3.5 trillion. Here is a quick look, again, more household views, but this is a kind of a view on household spending. And so this is 1 year ahead expectation. So this is essentially survey data that is coming out of the Federal Reserve Bank of New York and some of the work that they do. And so this is a reflection of spending coming out of the pandemic is going to continue to remain strong. So even as we sit here in August, looking ahead 1 year, spending is expected to be extremely strong, which comes at an interesting time because of the kind of the advent of this Delta wave of the variant, or Delta variant wave, I should say, kind of curbed some of the enthusiasm for consumer spending. But yet the numbers in August, looking out 1 year, are extremely robust. So the takeaway that I have from this chart against the backdrop of what we've seen in the real high frequency data is that the outlook for next year is pretty strong on spending. We know the consumers have the liquidity. We know that they, by these surveys, that they have the intention to spend it. And if we do get that velocity of spending in the system, that's definitely going to be good because consumption represents 2/3 to 70% of our total economy. Now here's a brief look at manufacturing. And as we've been following the surge in manufacturing, it's really a wonderful story. We knew that there was a law of large numbers that was going to catch up with us, and it has, and it has for a lot of different reasons. One, just a natural rate of change. When you're at an accelerated pace, at some point it's just going to slow down, and it has. Compounding that is a fact that we've got supply chain choke points, which I think are going to persist in some form and in some areas, for well over the next year. But here's the data that kind of shows us, I think, really where we are in U.S. manufacturing. On the upper left, you've got a manufacturing purchasing managers index. The actual number was a little bit below expectations. It's still really positive. Like I've said, anything over 50 in a diffusion index represents growth. Anything over 60 represents strong growth. And we're still at that level, even though we're off the peak. Now, if you look at the upper right hand, this is the backlog, and backlogs are still really strong. So this is, if you look at the upper left and you say, well, things are slowing down, you look at the right and you're like, well, backlogs are really stacked right now. And that's good for future deliveries. And if you go down to the bottom, here's the nexus of all that's going on in manufacturing is that output prices are moving higher, and they've been moving higher really without abatement over the last year. And so this is, what happens with this is going to be really interesting. The end prices to consumers for these manufactured goods, we're seeing pricing intentions moving higher. We're seeing companies that, the overwhelming majority of not only large companies, but small companies intending to raise prices over the next 12 months in response to what you see in the middle of this particular chart here. Here's just another representation of the tightness of all of this and the supply chain choke points. This is the Baltic Dry Index. It's a freight indicator. What we see here is really strong inventory, really strong activity, but also really high prices in shipping right now. Here's an interesting chart I came across in some research. It's developed by the OECD, and it gives you a cross-sectional analysis by in several countries and areas. And we know here in the U.S., we've kind of pat ourselves on the back because we've recovered dating back to pre-pandemic levels, basically the fourth quarter of 2019. And then obviously we had the pandemic, everything shut down, the economy cratered, but it bounced right back. And so we've actually, recovered our lost economic growth. And it took us a relatively short time, much shorter than usual, to get it back. However, if you look across the globe, we're on an island that, particularly in the UK, I mean, they are still 4 to 5% below the economic growth level that they enjoyed prior to the pandemic. And you see, in Europe, you've got the Euro area that's, essentially, 3 to 4% below where they were. And so, the U.S. has kind of won this interim horse race, if you will, that we happen to be amongst, particularly amongst the G7 countries, in much better shape. And so this is there's a lot of different kind of implications in this chart. One, that perhaps, if you just look at it on balance today, the U.S. is a better place to invest than overseas because we have exhibited better growth. However, there is recovery in these areas, even though they're below where they were. And so there's an opportunity for growth in some of these areas that may not exist as much in the U.S. because we've already demonstrated it. We've already, baked it into the numbers, so to speak. So I think this argues for this international diversification, where I think next year, perhaps there are at least some countries and areas of the world that will exhibit better growth than we will here in the U.S. Now here's some data coming out of Oxford Economics that I thought was really interesting. And so on the left-hand side, it's essentially a survey of business owners. It's that asks them over the last 2 months, have you become more or less optimistic over your prospects looking out 2 years? And so, some of this is due to the Delta variant. Some of it's kind of due to maybe a little bit of a cooling off of just overall enthusiasm, as we kind of get down to, more muted growth from the robust growth that we've had in the economy over the last year. But you can see here that really the two categories that had the most change were, a slight downtick and slightly more positive, and then a slight uptick here in what we show is a slightly more negative. So, a little bit less optimism, not necessarily a huge game changer. But if you go over to the right-hand side, you can kind of get a glimpse why. Now, Delta is one aspect, but I would argue that what we see on the right-hand side is has every bit as much impact into those numbers as anything else, because this is a survey also by Oxford Economics on when do you expect supply chain disruptions to conclude. And so you can see that there's a wide dispersion of responses, but really all told, you've got the responses here that are coming at least 6 to 12, and in some cases even more months ahead. So there's kind of this sober realization that these supply chain choke points are going to be with us for a while. Here's something that I found in the Daily Shot that I thought was really interesting, and this is data out of the Southwest, and what it shows, we know that there are pockets of the Southwest that are in deep recession, and this is evidence of that. You can see that the precipitation in millimeters has gone down tremendously, really in just a couple of years. So you can see that it's kind of cyclical like this, but we haven't had a data reading this low in quite some time. It's just really interesting. So it's putting some potential economic chokeholds on growth in the Southwest region. You've got issues related to agriculture, certainly with economic expansion and residential expansion, very heavy users of water. And then at the same time, what's interesting, you've got an average temperature that's moving higher. And, I'm not going to wax any, philosophical on why that's happening or whatnot. I'm just showing the data and observing that it is an issue. And so when you think about what's going on in the Southwest right now, this is essentially a picture of what the problem is, and it. It probably has some economic drag. I haven't seen any good studies yet that kind of elaborate on what the economic impact of this particular situation is, but it'll be worth monitoring in the days and months ahead. Quick look at the oil markets. We've talked about that we've had some struggles in getting rigs to open. We've seen some extraordinarily high crude prices as of late, and this kind of paints the picture why. One, we still have not recovered the lost output after Hurricane Ida. Had idled a lot of plants. We are battling back. You can see that uptick here on the left-hand chart. And the other kind of agent provocateur here on high energy prices is what you see on the right, and that's the fact that crude oil inventories are well below their pace. You can see that really deep red crimson line kind of well below the prior years, and so those two things are really hampering output, our ability to resupply at a time where we have seen overall decent demand for gasoline, and well, those are distillates, but the demand for crude, and then in turn demand for distillates like gasoline, kerosene, etc. So I'm even if we see some significant change in rig counts and oil production, we still have this inventory shortfall, and I think that sets the stage for higher energy prices for at least the next several months. Quick look at IPOs in the market. Very interesting here, and we are at a breakneck pace even still. So even if like these special purpose acquisition companies or SPACs have seen kind of their day come and go, we still have a lot of IPOs. And in fact, year to date, we have already eclipsed any year that we've been tracking over the last, essentially the last 20, 30 years. What I wanted to do, I was looking for a chart, and I found it here with Goldman Sachs, is kind of get a picture, as we're struggling with this whole notion of, is the government going to fund itself, or is it going to have to shut down? And we get these from time to time when we get, when the Fed has to go into extraordinary measures, the government's bickering and partisan divide on a continuing resolution to fund the government and to increase the debt ceiling, and that's where we are now. And there's some deadlines at the end of this week which are important. But I wanted to take a look at what the S&P 500 returns would look like, and Goldman does this here. And they, essentially the long and short of it is, after that budget authority expires, on balance, you really don't have a major negative response in the market, which is good. Not to say that it can't happen, but by and large, you don't see a lot of negative reaction. And some of this has to do with the fact that, usually at the 11th hour, sides come together and realize that brinksmanship isn't going to benefit anybody, and then they wind up jamming it through. But again, I just wanted to try to, put a picture to kind of this thought around what happens around these times. I thought this was really profound. This comes to us from BKA Research out of Montreal, and they always do great work. But this is a S&P 500 operating earnings, and so they go back several cycles and show the upward trend and obviously the impact on the recession. But you can see here that this is really, sales is the mother's milk, for growth and expansion, but earnings are what really drive valuations. You've got price to earnings multiples, and when you have the earnings moving higher, you're either inspired, if it's a momentum, you're going to have price to earnings multiple expansion, but you definitely need the E, and we've got it now. What's interesting here is that we've seen an acceleration of earnings, really the likes of which we haven't ever seen before, and it's moving so much higher. And you can see that arrow pointing almost up to the sky, whereas previously we've seen a little bit more protracted recovery. Here's a quick check-in on the government yield. As this is the 30-year less the 5-year Treasury spread. And so it's essentially the difference between these two yields. And what you see here is that yield continues to come down. We've been following this for the last several weeks, and you can see, it did come down in July, kind of reset to a new level, but we've seen weakness. And then lately we've seen a sharp deceleration, as we've seen perhaps a little bit of movement at the shorter end, perhaps. But we are seeing flattening. It reflects a little bit of that lower optimism that I was talking about a few minutes ago. But again, like to point out that the outlook, at least from a business perspective and S&P 500 operating companies perspective, is that next year is going to be okay, and it's going to be positive. With that backdrop, you'd expect the spreads to be, perhaps widening a little bit with the expectation that inflation is going to pick up, but we don't see it right now. And that's the kind of the really bizarre disconnect that we have right now in the market. But we'll continue to monitor it. Ordinarily, a flattening of the yield curve is more akin to, expected slowing in the economy. And I don't see that as much as I just see slower growth. We're not contracting, but we're not growing at the pace that we were previously. Again, that's okay. It's expected. We're in an economic cycle. We may have passed peak growth, but cycles can last a long time after peak growth. That's all we've got today. Appreciate you listening to this on behalf of the entire team. Hope you have a wonderful week, a safe week. We'll talk to you again soon. Take care.